The Aussie dollar was already falling at 11.30 when the March inflation data hit the screens because the US dollar popped up for some reason. And then the slide continued when the headline inflation rate, that is including fuel, was a bit less than economists had penciled in, although the trimmed mean, excluding fuel, was as expected, which meant the market odds of a rate hike next week fell from above 80% to 71%. And for the rest of the year, the odds are down from 240%, which basically means 2.5 more rate hikes, back to below 100%. That is, a hike is no longer a certainty. This graph compares actual trimmed mean inflation with what the Reserve Bank predicted for today's number and what it's predicting for the rest of this year and next year, bearing in mind that the forecast in February was based on what the market was predicting for the cash rate, which was 2.5 hikes. Apart from diesel and petrol, inflation is pretty much under control, really. The two problems are first, that high inflation from fuel might flow through to wage claims, and second, those claims might be paid and lift underlying inflation because the labour market is still a bit tight. This graph here compares unemployment now against the pre-COVID average in Australia, the US, UK, Canada and New Zealand. And Australia's low unemployment is an outlier. Anyway, the dollar is down a bit at 71.6 US cents. The share market fell for the sixth session in a row. G8 Education shares were slashed after the company said it's closing 40 childcare centres because of sustained affordability pressures leading to a big fall in occupancy. I suppose a cut in the price would have been out of the question. The US market fell while Asian markets went up, and oil and copper fell while gold and silver shone. And that's finance.